Hi friends, welcome back to Murthy Finance Academy. Today we will discuss an important player in the pharma and CDMO space, Aarti Pharmalabs. If you look at Aarti Pharmalabs Q3 numbers, you would probably want to run for the hills. Revenue down 10%, profits tanking nearly 40%. But what if I told you the company essentially stored 19 crores of profit in a shipping container that just hasn't been opened yet? Today, we are peeling back the accounting hide of Aarti Pharma Labs. We are talking about a mid cap specialized major that has the regulatory maturity of a blue chip, but the aggressive growth targets of a lean chemistry shop. Is this a J curve investment opportunity, or is the management just making excuses? Let's dive in. First, let's look at what APL actually does. Since demerging from the Aarti conglomerate in 2022, they have focused on complex small molecule chemistry. They aren't just another generic player, they are a global price setter. The three pillars of APL are xanthine derivatives, which is around 49% of the revenue. They hold a 15 to 20% of global market share in caffeine. Think global giants like Coca-Cola and Pepsi. These customers prioritize taste and reliability over price, creating sticky revenue. Second segment, APIs and intermediaries, which contributes nearly 39% of the total revenue. This is focused on chronic areas like oncology and diabetics. The third segment, CDMO or CMO, which nearly contributes 12% of revenue, the high growth engine with 59 active projects and a North Star revenue goal of 1,000 crores. So there is a regulatory armor for these companies. They have 3 US FDA approved units, 59 US DMFs, and 44 CEPs for a mid cap. That is a massive barrier to entry. So the environment for Indian API makers is shifting from survive to thrive. Two major catalysts are helping Aarti Pharma Labs. One, China's rebate withdrawal. Beijing removed the 13% export rebate on caffeine. This stripped away the subsidy Chinese peers used to undercut prices, allowing APL an expected 8 to 10% push. Second, the Trump tax. The US is signaling a 20% duty on Chinese chemicals. But here is the kicker, Indian caffeine is on the annexure list, meaning it stays duty free. So, what is the bottom line? APL is effectively protected by a US led trade wall while its competition gets penalized. So, now let's address those ugly Q3 numbers. So, the company in Q3 generated nearly 425 crores of revenue and 44 crores of PAT. So, here is the secret, a massive 49 crore shipment was in transit under delivered at place DAP terms as on December 31. Under accounting rules, they couldn't book it until it hit the customer stock. Okay. So if that shipment was booked, revenue would have been flat year on year. INR 19 crore would have been added to the profit before tax, and its net debt to equity is at a conservative of 0.26 times. So there is an Atali drag. APL is paying nearly 1.4 crores monthly in operating expenses for their new Atali plant, which isn't even producing revenue. That's an 18 crore annual drag. It's a classic J curve, pay for capacity today, reap margins tomorrow. So if you see some management, what they are guiding on this company is, it's not all sunshine. Management faced hard questions this year. So they blamed newer staff for validating hiccups at the new Atali site. And for a veteran group like Aarti, newer staff sounds like a schoolboy error. This mistake forced them to lower their EBITDA guidance from the growth to flat to marginal. There is a credibility tax on the stock right now because they missed their own targets. So some other red flags which I understood from the management's conference caller, customer concentration, 80% of CDMO sales comes from just 7 to 8 projects, and working capital is also very high with inventory days between 188 and 230 days, and there is a generic treadmill. Prices for APIs will go down. They must constantly launch new molecules like apixaban just to stay still. So if you look at the valuation, uh, is the Aarti Pharmalabs currently expensive? APL trades nearly at a PE ratio of 30.2. Compare that to with Torrent Pharma at 64.2 or Divi's Lab at 67.2. So the market is discounting APL for small cap execution risks, but it's not pricing in the 8 to 10 times scalability of the Atali side. If they execute and the factory starts working perfectly by March, this discount could disappear fast. So, Aarti Pharmalabs is a story of temporary fiction for structural gain. To see if the thesis holds, watch the below key monitorables, which I'm saying. So, does the 49 crore in transit show up in Q4? Second, does the Atali site stabilize by March? And will the inventory days drop towards 180? If you observe these things, if they are going to deliver on these metrics, then we can see a re-rating in the share price as well. So if you quickly compare its main peers like Newland Laboratories or Supriya Life Sciences or Haika Limited, in revenue, the Aarti Pharmalabs generated nearly 425 to 432, Newland between 440 to 480, and Supriya around 209 crores, and Haikal around 320 crores. EBITDA margins is around, for Aarti Pharmalabs, it's nearly 23 to 24. Newland is stayed at around flat at 19%. Supriya Life Sciences is having a 28 to 30%, and Haikal is a negative net profit kind of a scenario. And even the PAT is also, the company generated nearly 48 crores of PAT. Newland generated 40 crores. Supriya Life Sciences generated nearly 49.7 crores, and Haikal reported a net loss of 5.9 crores. So if you see the core strengths, Aarti Pharmalabs core strengths is Xanthines, and Newland Laboratories is into complex CDMO or CMS. Supriya Life Sciences into niche APIs like antihistamines, and Haikal is into agrochemical and pharma CDMO. So if you see, even with the operational hiccups at the Atali side, Aarti Pharmalabs maintained an EBITDA of nearly 23.6%. That is significantly higher than the Newland Laboratories, despite Newland having a much higher PE valuation. This suggests that APL's core business, Xanthine, is incredibly resilient. And APL is currently trading at around PE of 30 times, which is a massive discount compared to Newland or Haikal. If APL fixes its Atali plant production issues by Q4, as the management expects, there is a strong catch-up potential towards the valuations of more stable peers. And if you come into Supriya Life Sciences versus Aarti, Supriya Life Sciences currently shows a better growth numbers, but APL has a larger revenue base and a more diversified regulatory armor with 3 US FDA units. And the shipping container impact. If the 49 crores in transit had been booked in Q3, APL's revenue would have surpassed Newland Laboratories, making it in the leader of this peer group. So, hope you like this video. If you like the video, please do like, share, and subscribe to my channel. Also, please watch my previous videos. Every day I'm posting few companies related to one sector, so that you will be getting a diversified analyst views. If you like the video, please do like, share, and subscribe. Thank you.